as spring gets underway, it seems that stimulus and the virus receding have also blown in some pretty hot numbers on the economy. I'm thinking in particular about the Philly Fed Business Activity Index at the end of the week, last week, up to 51.8. It's the highest since 1983. Prices paid at a 41-year high. And this is even before we get the economy fully openated, everyone vaccinated. Could this be a canary sort of in the economy's coal mine about a recovery that may even be stronger than the Fed and others are expecting?
Well, I think we're going to have a very strong spring and summer. You have vaccines rolling out at a very strong rate. You have the cases going down the virus. That's obviously the place this thing all starts. You've got a lot of pent-up demand from people like me who've been isolated for the last year. Those people have excess savings in their pocket. The savings rate has been quite high over the last year. And then we've got another $1.9 trillion of stimulus coming into the economy. So I think you're going to see demand very strong. And as I talk to my contacts, even this week, as the stimulus checks hit, people, especially low to medium income retailers, really saw a surge in demand. So I think you're going to see that in spades. I think the other thing the Philly Fed referred to, of course, is manufacturers are going to have to work hard to keep up. And I think we're already seeing supply chain challenges throughout the economy. You've got backups in ports. So I think you're going to see very strong demand. I think you're also going to see some issues in meeting that demand.
And that, of course, is what's, I think, fueling some inflation forecasts. For some people, it's concern. Maybe for others, it's an opportunity. But I want to put something in front of you. Former Treasury Secretary, I should say, Larry Summers, was on Bloomberg Television on Friday. He's been warning about the economy overheating and boosting inflation. Bond yields are surging. The massive fiscal stimulus is taking hold. The virus continues to recede. Let's listen to what he said. And also, I guess he mentioned the Fed continues its aggressively stimulative monetary policy.
It seems to me that what was kindling is now igniting. And I am much more worried that we'll have either inflation or we will have a pretty dramatic fiscal monetary collision. I think this is the least responsible macroeconomic policies we've had in the last 40 years.
Concerned, and you know, we can take out the politics because he's known as a liberal Democrat. How do you respond as a Fed official to that?
Well, I think, as I said, we're going to see an extremely strong year. And I think that strong year is going to lead to price pressure. Some of that price pressure is going to be because we're rounding over deflationary comps from last year. And as those leave the baseline, you'll just see prices jump up. Part of that is going to be this supply-demand imbalance that I was talking about earlier. And part is you're starting to see expectations start to creep up, not yet to our hurdle, but getting closer. I think you'll see price pressure this year. I want to emphasize inflation's not a one-year phenomenon, it's a multi-year phenomenon. And so to have inflation over time, which I suspect is what he's talking about, you'd have to see expectations really move. You'd have to see, businesses start to think that every year they need to see 3 or 4 or 5% price increases. You'd have to expect workers to start to see those kind of compensation increases. We certainly haven't seen that yet. And as I'm talking to businesses in my district, I still hear them struggling with the idea of taking price, given all of the disinflationary forces they still perceive, whether that be technology and its ability to let you price shop, or global supply chains or global talent pools and their impact on labor, or the power of big box retailers to negotiate. And so I still don't hear that. But of course, that's something that I'm trying to stay on top of. And were that to change, our forward guidance and our tools allow us to do what we need to do.
I want to quote another Fed person, former New York Fed Bank President Bill Dudley. I spoke to after the Fed meeting on Wednesday. He said he's not concerned about the rise in bond yields we're seeing now, but he sort of echoed Larry Summers when he said he's worried about what happens if the Fed is too slow in tightening monetary policy. Inflation starts really rising, and then the Fed really has to speed up the rate hikes. He said that wouldn't be pleasant for financial markets. Larry Summers said he sees about a 30% chance this is what's going to happen and cause a recession. Is that a concern? At what point does it become one?
Well, there are a lot of scenarios out there. And I'll just say our guidance suggests we would be raising rates were we to see inflation start to spike past our targets. And so I think we have the tools to handle it. But I would agree with anyone who thinks this amount of fiscal stimulus at this point is new for us. And so, we've got a set of forward guidance out there that I believe, allows us to tackle should the downside scenarios come. I'd remind you, we're still looking at 12-month inflation of 1.5%. So we're very worried about the future, but the present still doesn't show it. But were it to show, we have the tools to handle that.
Glad you talked about forward guidance, because also speaking about the last meeting, it looks like a slight shift in forward guidance, because 7 of 18 FOMC officials now see rate hikes by 2022 or 2023. That's a jump from the December meeting. Are you on board with that? Did you change your dot?
Well, I wouldn't call it a shift in forward guidance at all. The guidance is exactly the same as what it was before, word for word. What I would say is that there have been some of us who've shifted our forecast. And so our forward guidance, which is outcome-based, says we would start to move rates when the outcomes move. And so, one big thing that's happened since the last SEP was, of course, the passage not just of the $900 billion fiscal package in January or December, but also this most recent $1.9 trillion. And so shouldn't be surprising that with a couple, $2 or $3 trillion extra dollars of stimulus into the economy, people would forecast a faster growing economy, and that some of those people would say, therefore, that inflation would rise faster, our forward guidance would be met, and they would raise rates sooner.
Well, yeah. But it's interesting to me because Chair Powell did seem to kind of downplay the importance of the dots at his press conference. Now, in the past, it seemed the Fed had promoted dots, certainly when they first came out, as a way to augment forward guidance, give investors, give the public, give Congress a sense of where the Fed is going, such that it seemed like dots were a policy tool. But what you've said and Jay Powell's dismissal of them seems to indicate, they're less important now? They're no longer a policy tool?
Well, I have a lot of empathy for the chair, because he's now doing a press conference every time. And when he does those press conferences, he stands up and has to defend the dots. I'll just remind the audience of how the process works, which is there's a memo which comes out every meeting that is voted on by the committee and is heavily litigated back and forth in terms of what precise word we're going to use in what precise paragraph. And then today, with 18 members of the FOMC, there are 18 of us who individually with our teams come up with a forecast. And, it's almost like, a card game where we all show our cards at once. There's no effort to try to align that, to massage it, to manage it, to talk about what it is. It is what it is, which is 18 individual forecasts. And that does tell you something. I find it to be a very good exercise, frankly, to discipline my thinking about where the economy is likely to go and, where rates are likely to go in that context. But there's nothing about that is managed to be the voice of the committee. And so I assume there are times when the chair, as he, defends our memo, which is what we vote on, feels good about having that forecast because it emphasizes what he's trying to say. And I'm sure there are times where he's got to say, okay, I've got to respond to this because it doesn't exactly come out with.
Okay, so it's not necessarily, so we should no longer consider it forward guidance or part of the policy toolkit of the Fed?
I think it is a transparency toolkit. It is a transparency tool, but it's not policy. Policy is dictated by the rate we decide to go and the memo we vote on. Okay.
I want to talk to you now about the supplementary leverage ratio, because this was a pretty big story on Friday. Not unexpected that the Fed decided it wouldn't extend it. And of course, it was a step taken during the pandemic to help banks, to help them keep buying treasuries, holding treasuries. By removing it, banks, it will make them potentially, all other things equal, it'll make it cost a little more for them to hold treasuries at a time when the government is selling an awful lot of them. If they don't want to hold as many and buy as many, yields could go up, right? So the Fed seems accepting of that. And I know the one person I've talked to thinks maybe this is like almost like the first step, the first flirtation of the Fed with tapering, with not doing quite so much to support or suppress lower bond yields.
Well, I think I'd put it a little differently, which is in March, a year ago, things were highly uncertain. Markets were having real trouble functioning. We intervened in a very significant way. And there are a lot of interventions we set out there that we've now at the point where we can roll back. I mean, the facilities that didn't expire at the end of December, with the exception of the PPPLF, they're all expiring at the end of March. And I think this is just one more extraordinary measure that is, I think, naturally expiring as we get to the back end of this. I think there are fair questions about what the right leverage ratio is, and that's why we're going to take a full look, put it out for comment, do what we do when we take a fair look at it. But I think it's probably good news that a lot of these extraordinary measures that were launched a year ago were now close enough to the back end of this that we can see them expiring.
If yields keep rising, I know that you and the Fed chair have both said, look, people are more optimistic about the economy. So it's kind of, you should expect higher rates. I think a lot of people get that. But if they keep rising and the Treasury sells more and more bonds and they keep rising, is there a point where where you would be on board with increasing the bond purchases, the 120 billion, maybe even reinstituting yield curve control, which the Fed up until now has been kind of reluctant to do?
Well, I have to say, we do have tools like the ones you've suggested, were we to need it in times either of a second wave or fourth wave of this or market malfunction of some sort. Of course, we have those tools. I have to say, I'm really hopeful we're on the back end of this, that, we're talking about where we started, 1.9 trillion of stimulus on top of 900 billion of stimulus, vaccines rolling out, virus coming down, hospitalizations coming down, deaths coming down, an economy that I think is going to have a very strong back half of the year. So, with all of that in play, I'm really hopeful that we're going to be talking about, how great it is the economy's back rather than how many more tools we're going to have to use to try to support it. But we'll have to see.
Well, implicit in that, then, are you saying that, look, if yields rise, that's fine. If they're rising on the back of a strong economy, if they're rising because more people are investing, there's more demand for capital, folks, just get used to it. That's what the economy does. Is that what we can take away from your view, from Jay Powell's view?
I won't speak for Jay, but I'll just say I take great signal from what seems to be driving yields up. Part of it is rising inflation expectations, which, whether it be medium term or long term, seem to be moving toward, not yet over, our target levels. Many of the days where there have been movements have been days where you've had really good news on the vaccines or really good news on fiscal stimulus. And to the extent that yields are responding to the economy, I think that's what you want them to do.
I guess what I'd like to ask you before we finish up is, calling on your many years as a businessman, before you came to the Federal Reserve and got into monetary policy, you have a vast network of people you worked with, that you continue to talk to. What are you hearing from them now? Are they more confident about the economy? Are they getting ready to take steps they wouldn't have taken? What are you hearing?
I hear strong optimism. I think strong optimism, first and foremost, because of rollout of vaccine, dropping rates of the virus. I hear, as I think I said earlier, that this latest stimulus package, like the one in January, really has hit the consumer economy strong, and that means we're going to have a very strong start to the spring. I do hear concerns about supply chain, concerns about manufacturing, concerns about being able to meet demand. Also true on the hospitality side, where people are nervous about getting workers. And it's a funny situation, because if you're in technology or in manufacturing or in healthcare or in construction, you really can't find workers right now. On the other hand, you've got somewhere around 9.5 million of excess personal contact service workers, many of whom will be called back in the next 3 or 4 months, but probably not all of them. And so you've got tightness in the labor market in parts, but not obviously, in total.
Okay.
But again, my view on what's going to happen isn't driven by models. I think you're right. I spend my time talking to businesses big and small and trying to figure out what's happening on the front line. And right now, I think they're pretty optimistic.
Well, I just want to ask one very quick question to fit in before we have to let you go. All of this you're talking about makes me think of two things. One, isn't this a reason inflation could get hotter? And is there a possibility that as long as there's stimulus checks, some people will be more inclined to stay home and wait for things to get even better or get back that job they once had rather than going back to work?
Well, so on your first question, like I said, I think we will see price pressure this year. Whether that turns into inflation over multiple years goes down to expectations. And again, I have not seen a sign of that yet, but I certainly am watching that. In terms of getting back to work, I think it is a really interesting challenge on two dimensions. First of all, I do think you have a lot of parents, primary caregivers, also elder care, who have been stuck at home because kids haven't been in school, because childcare hasn't worked for them. And I am worried about what percentage of those won't come back in the market. This is not related to stimulus. It's related to, I'll call it anti-stimulus, the fact that so many of the support functions that parents depend on have suffered trauma during this thing. So that's one part I'm worried about. Then there's another part, which is you were once a waiter. You're waiting for your job to come back. There's still a lot of people in the economy who declare their job loss as temporary, but it hasn't come back yet. But you're still waiting for it to reopen. You're not retraining. Community college enrollment is down. And so I do worry about that mismatch as well. Not so much driven by the stimulus or the support, more driven by the trauma in the economy and frankly, the fact that the jobs that are hiring may not be good fits for the people who are out of work.